Humphrey, let's just take a step back and take a look at how the market has performed overall, where we've seen the bond market, where has most activity been centered around so far this week.
Good morning, Samantha. Thank you for having me again this morning. The bond market and the fixed income market generally has been doing well. Earlier in the week, we experienced a sort of slow transaction and trading because of the earlier announcements of the switch by the DMO, which they are not yet to come out with the modalities. However, we saw a consistent and persistent decline in yield, especially on the short end of the yield curve, talking about the treasury bills. Also, we've seen a sort of switch from those who have been investing in treasury bills to bond market, which is actually their major concentration is now on the shorter end of the yield curve, talking about the smaller and the shorter maturities we have, talking about the less than 2-year bond and the 5-year bond we have in the market. As at the close of business yesterday, the less than 2-year bond were closed at 14.95, which is actually higher than the yield you can get from a 1-year treasury bill, which CBN had a stop rate kept at 13.85 as at yesterday's stop rate.
In terms of foreign activity on the market, it seems that many are saying that foreigners have been selling these treasury bills. Is this a sign of rising risk aversion globally and investors just exiting from frontier market assets right now?
Actually, presently, you need to understand that the nominal interest rate cannot be a good measure to say that an investor can take a decision. They also look at the real return on investment. Presently, I do not think that the foreign investors will be selling down on what they have present because they are still having positive real return on their portfolios or assets they have now in Nigeria. I think what they are looking at is that they are trying to reallocate what they have, at least selling down some of the bills and putting them in higher yields in the bonds.
Okay, let's take a look at some of the macroeconomic forecasts that have come through from the Statistics Office, looking at 6.5% growth for 2012. That would be lower than the 7.4% we saw in 2011. And then you've also got inflation, which is expected to go to 13.6% this year. That's from 10.6%. So on the one hand, you've got slowing growth, and on the other hand, you've got the problem of rising inflation. What does this mean for the fixed income market, and how do you position yourself in light of these two opposing forces?
Yes, Samantha, I think we Nigerians is what I may regard as a state of economic dilemma. We are looking at a situation where the headline inflation is hitting 15% and the yields are declining. So in such a situation, it may be difficult for an investor to take a decision. But my take on this is this. I think we've said it for a long time that it is actually dangerous for you to associate the monetary policy tightening or easing with what we may regard as a nominal interest rate. Presently, I think the inflation that is rising, which CBN has already mentioned earlier in the year, that because of the fiscal discipline and part of the spending, part of the fiscal discipline that the federal government has adopted, it may likely spur growth in the economy. But their fear is the channeling of the funds, which actually add to the cost of production, which is a cost push into it. And also additional is what we'll talk when we talk about pass-through inflation, which comes out because Nigeria is highly import dependent. I think at this point in time, it's difficult for an investor to take a decision, but the foreigners present in our market, I think what they're looking at is the real return on that, which is still positive presently. So I think based on that, we are still receiving a whole lot of inflow.
Let's look at the Naira, because it has weakened slightly. It weakened to its 6-week low yesterday on the interbank market, sitting at 157.85. Overall, though, it has been a picture of stability that we've seen in the currency. Your thoughts on the Naira as we have the oil price under pressure right now? We know, of course, as you say as well, that the Naira peg is very important given the fact that you are so import dependent.
Yeah, to a very large extent, I would say that the Apex Bank have been able to achieve a sort of stability in Naira. The last stop rate as well was at 155.75, and yesterday they maintained the same level. Even though we are getting some sales from the autonomous sources, I think presently at that level, CBN putting a sort of oscillatory band has actually helped them to hold that position. But my fear presently is that with the large decline in the yields in the fixed income market, the issue may cascade in actually giving a problem to our maintaining exchange rate in the near future, because I will see a situation where we may experience a sudden and massive exit for some of these portfolio investors, and this will put a lot of pressure on our exchange rate, which is what we actually regard as exchange rate overshooting.
That is a big risk right now. If you had to assign a probability of that happening, of a massive exodus of foreign funds from the local paid debt market, what type of probability would you assign to this? How much of a risk is it right now?
Yeah, presently one will never be able to assess, but I think presently the market is not yet deep enough for us to actually start. So we should be talking about protecting our market this time around. But I think at this juncture, I think what the market should do is to see a situation where we may go into breeding some of the hybrid products that may give options, sort of putting some basket of bonds or T-bills that can be sold as one single product. Actually, the yield may be low, but the aggregate may actually give them the better yield that can still maintain the market. Because what they are looking at presently, once they start getting a negative return on real investment, exit will be imminent.
If you had to be buying then any of the bonds right now, which ones would you be betting on in terms of producing those returns that you would like?
Yeah, presently, I think the source of FDI will have need to be skewed to investment that can actually spur growth, talking about investment that can yield a fixed capital flow. The fact that we are still in resource sourcing FDI may not surely assist the country presently. We need to move straight to the secondary level of foreign direct investment, talking about the manufacturing sector. So presently, I think the policies in place, the tax holidays, all the things that they use to keep the environment quite attractive for the investors to view should be skewed towards the direction that will actually bring up employment, talking about the manufacturing sector. But presently, I do tell you that we may be losing a lot through outflow by talking about, if we are still concentrating on resource-seeking FDI, which is actually being done by so many expatriates. So you see that in some situations, you find out most of the figures we get are more of payment for services rendered by these people. So at net, I think we'll be paying more for imported goods than what we are getting for selling most of our crude products through this resource sourcing FDI.